This online lecture is on the content of Chapter 8, Data Requirements for Pricing, and we'll be trying to now delve into the costing process. We are well within this flowchart that I have already shared with you in a previous lecture. Specifically, we're looking at the left-hand side of those little cylinders that are the data that we need for the costing process to work. And you can see that starting from the top, you have data on claims or losses, as I've called them here, and that's normally on an individual basis, but sometimes it's aggregate losses, the amount of losses per year. Then you have the exposure data, that is information on the amount of risk we are going to take in. And then we have portfolio market data, that is information not specific to the client that we are for which we are trying to do a costing exercise, but they can come from other sources, like different clients in our company, different clients that we are insuring, or from external data like industry studies. And in both cases, these are relevant when we don't have enough data from our clients to have a solid pricing, and we need some help from the outside. And finally, you have what I call here cover data. Could have called it, I've called it elsewhere, policy data, which basically tells you what you're actually covering. So limits, exclusions, terms and conditions, etc. In the next slide, we given the same information in written in non-graphic format, so I'm going to skip this. Let's start with policies data, which was the bit at the bottom of the flowchart. Policy data is important because it defines what claims will be valid or not. So it's important to see to have as much information as possible on the policy itself. Now, policy data can be different depending on whether we're talking about personal insurance, commercial insurance, or reinsurance. In the simplest case, which is commercial lines insurance, we normally have one policy, and therefore the information that we need is quite basic. When it starts, when it ends, what's the deductible, what's the limit, and a number of other bits of information. In the case of personal lines, of course, you cannot price every individual customer on a standalone basis, so you will have a number of different policies, and of which you are going to look at the claims and then produce a model. So the information will be much more complex. In the case of reinsurance, you do have a single reinsurance policy between the reinsurer and the reinsured, but the reinsured is often reinsuring a number of underlying policies. So for example, if the reinsured wants to reinsure its employer's liability portfolio through a treaty reinsurance, through an insurance treaty, then there will be a policy between the reinsured, let's call it Allianz, and the reinsurer, let's call it Swiss Re. There will be one policy, one contract between them, but Allianz will have as its clients a number of different companies to which it has sold in employees liability insurance. Let's say McDonald's, KFC, Marks and Spencer, etc. So there will be a number of different underlying policies between different corporate organizations such as McDonald's, Marks and Spencer, etc., and Allianz, and then altogether they are reinsured to Swiss Re. Okay, so there's this distinction. Typical information that you have on the policy is shown here. A policy identification number, which is very useful to connect it to claims information that we have, and then of course the start date of the policy, called inception date as well, and the end date of the policy, called expiry date as well, in which we have it here. And then we'll have policy limits, excess points, the deductibles that we have spoken about in Unit 3. In case we are in the London market, sometimes there will be information on the percentage of the policy that an insurer is insuring. So, for example, 20% of whole risk is insured by Allianz, 80% by other players. This is much more common in reinsurance, but it's common. It's used across the market. Then you may have other rating factors, exposure measure, etc. Details of premiums charged, and the type of coverage. For example, bodily injury or property damage. Details of an exclusion. For example, you may have excluded nuclear risk, etc., etc. And these fields are more or less common to all types of policies in direct insurance. That is, insurance between a customer, an individual, and an insurer, in the case of personal lines, or a corporate organization like Marks and Spencer and an insurer. This is called direct insurance. In the case of reinsurance, things are slightly more complex, and you may have a few more fields. For example, the type of reinsurance that you write in, whether it's proportional or not proportional, the type of the basis of the cover, and we have essentially three: losses occurring, claims made, and risk attaching, which is not listed here, but you will see it later on. Treaty limits, excess points. Now, since this is about reinsurance and we haven't mentioned reinsurance at all so far, I will not get into it now, but you will be able to understand all these terms better when we move on to chapter 20, where we start speaking about reinsurance pricing specifically. Yes. This is an example of policy data for a portfolio of policies, and so you can see that you have roughly all the fields that I had mentioned before, starting from the policy ID, inception date, expiry date, the territory of the policy, the name of a client, and here this is real data that I had, of course, to anonymize. And this is the class of business that it's writing. This is professional indemnity. This is D&O, directors and officers. The industry sector in which the company operates, and this will already tell you that in this case we have commercial lines policies. So in this case you have project management company. Here it's a manufacturing company or an energy company. Then the currency in which the premium is being charged, and then information like the limit, the deductible, the type of policy, whether it's standalone or it's an excess policy. This is something we haven't really addressed, but you will understand better when we look at reinsurance and other types of commercial lines insurance. You will understand the distinction better. I think that for now you might want to ignore this. And then of course the premium that you've charged, the amount that you are deducting for brokerage. So this information tells you that this data comes from a broker, and the net premium is simply the gross premium charged to the client minus the amount that the broker has kept for itself. Moving on to claims data. These are the typical fields that you can expect in an Excel spreadsheet, giving you information on all the claims that you have had for a particular policy. You will have something that identifies the claim, an ID, and of course you need to know, if you have more than one policy involved, to which policy does that claim refer to. And each claim will have a loss date, the date when the loss has happened, the date when it's been reported, the date when a loss amount has been put on the system, and maybe a date when the claim has been settled. Also, you will have very often information on whether the claim is still open, it's closed, it was closed and it's been reopened. You have information of how much of the claim has already been paid and how much it's left to pay. Finally, you will have information on the incurred loss amount. That means the overall amount that you eventually will have to pay. And this is really contained in the previous two bits, because that's the sum of the paid and outstanding, plus any fees that you have to pay, for example, for legal services, any recoveries. Sometimes you pay a claim, but then you recover some money because you identified as some third party at part of the blame, and therefore you ask them to give you some money back, or you pay for some property damage, but then you able to salvage some of it, maybe 20% of the value, and resell it. And that is for you, of course, something that has to be deducted by the overall cost of the claim. And then other information like currency, payments and outstanding amounts, the type of claim, whether it's a bodily injury or third-party damage or own damage. You see, there's many different types of claims that can be covered. For example, by a car insurance policy, you can have all these different types plus others. Finally, the type of peril that has caused the loss. For example, a fire, a flood, in the case of property damage, or an earthquake. Moving on. And so you have claims data, and you will normally have claims data over a period of time. And this period, at least for commercial lines insurance and reinsurance, is about 5 to 10 to 15 years. There's no hard and fast rule on that. but that's something that is quite common. And it's interesting to ask why we don't use many more years, even if we had the possibility of having information on a longer number of years, and why we don't use less than 5 years when there's a lot of data. So I invite you to think a bit about why this figure is normally used, and the answer you will find it on in chapter 8. But before reading the chapter, I strongly suggest that you have a bit of a think about it, and if you're not happy about what you find or what you read on the book, feel free to raise this in the class or elsewhere and we can discuss it. So moving on, here's an example I gave you before. Earlier on, I gave you an example of policy data from a portfolio of policies. Here is an example of claims data for a particular commercial lines client. Okay, a corporate organization. Let me see what this could be. This could very well be an employee's liability policy, because you see the type of circumstances of the claims: manual handling, slip and trip, falling or flying object. This is all liability, obviously, and the type of circumstances seems to indicate that a paid employee was doing this job, rather than, let's say, a guest in a building. So yes, these are probably employer's liability claims, and you can see that for every claim you have the claim ID here. Then you have relevant policy, and you can see that while the claim is different, the policy remains the same. So that indicates that these are all claims from the same employer's liability policy. Then there's the name of the claimant, of course. This has been anonymized. The loss date, the reporting date. Obviously, the reporting date is always after the loss date, and the circumstance, or let's say the claim description, and in this case we have also the injury description. That might be relevant when you try to conjecture what type of amount the claim will be, and the territory in which the claim has happened, the settle date, and obviously not every claim has been settled, so some of the fields, some of the rows have been left blank. The status of a loss, here it's quite simple, all the settled are closed and the ones that have no settle date are open, so it doesn't really give you a lot of information. But sometimes you will not have the settle date, but you might have the loss status, and you can use that in your calculations. The currency in which the claims have been made, and then the total outstanding amount, so in this case which is settled, so there's no outstanding amount. The total paid is 33,000. The total incurred, which is this plus this, this of course equal to the total paid. And then you have some fees on top of the total incurred. So this is basically the full indemnity of the claim. But then there are some fees, for example, from lawyers, and and then there are the recoveries. And the overall amount, as you can imagine, is the total incurred plus the fees minus the recoveries. Okay, it's probably helpful to write it here. So this is total incurred plus fees, excruciatingly slow, but we get there, minus recoveries. And once it appears, lovely, we'll say it's equal to the overall amount. Okay, moving on. This is an example of reinsurance data from, if I remember correctly, it was an energy client. And now this reinsurance data is a bit different normally in the way it is presented, because claims are bigger normally, so it makes sense to look at each of them not only in the current outstanding and paid amount as in commercialized insurance, but the full history of how they have been paid, because that gives us information on statistical information on how well we are predicting the final amount, and maybe we can make adjustments in the future, find patterns in the way we reserve our claims. And I'm not getting into that now into too much depth, because we are going to speak about that when we speak about reinsurance. But for now, I just wanted to show you an example of how reinsurance claims are presented to a reinsurer. And unfortunately here there's a this table has some problems. The original table had some errors, and I will tell you in a minute what this error is, but you see that, first of all, let's try to understand what's the content of this. You see, for each claim there are 3 rows, and the amount, they have the same claim ID, because they have the same claim, the same loss date, the same loss year, but for each row there's a different field. This is the amount paid, outstanding and incurred. So that tells you, for example, that in 2004 this claim happened in 2004, and in 2004 already it was known that there had been such a claim. Sometimes you have to wait a couple of years, or 3 or 4 more, and it was decided that this claim will be about 4,050,000, and that's the total amount, of which nothing was paid. Now, I told you there's an error here. Normally the incurred here should be equal to the paid plus the outstanding, right? But in this case you can see that the paid is 0, the outstanding is 4,050,000, and the incurred is 4,050,071 pounds, I think. And these 71 pounds well, are obviously an error, because this number should be exactly the same as the outstanding. You can I have corrected the error now. In the book you can find in figure 8.4, which I invited to look at the correct figures for all these claims. But I just wanted to highlight that there's an error here. But let's move on and let's see what the story of this claim has been. In 2005, the estimate of this claim has been reviewed and has been lowered quite a bit, from 4 million roughly to 2.5 million. Probably the company, the insurer, got more information about this claim, and as a consequence it has revised its estimate and lowered it quite a bit, and still hasn't paid anything. In 2006 there's been another major revision of final amount of a predicted, expected, estimated amount, and has been, now it's around 800,000, and at that stage the insurer has already started paying some part of the claim, around 300,000, and the remaining 500 here are still outstanding. Then nothing much has happened later on. The estimate has been revised again downward, but not by much, and finally it has stabilized and it has been paid completely. Again, there's an error. These two numbers should be the same. Again, I'll invite you to look at figure 8.4, which will give you the correct figures. In here you have an example of a claim, let's give it a name, 211219, that has happened in 2004, but it has been reported only in 2005. Okay, and so on. Again, all the figures are a bit messed up here, so don't wreck your brains trying to reconcile this with how things should be, and refer to the correct figure. Now let's try to move on to the next slide. We spoke about policies data and claims data. We can say now a few words about exposure data. What we need, as you will see in the first piece of coursework, is that in order to do pricing, you need the amount of risk that you have in every year for which you have claims data. The pieces of exposure that you need is, of course, the estimated exposure for the renewal period, because that will tell you how much the risk will be in the year for which you are pricing the policy. That is a renewal period, the renewal of the inception of the first, on the inception of the policy that you're writing for the first time. Then you need historical exposure data for the period over which claims are available. Okay, so let's assume, for example, that you have a public liability policy like here, and that you want to find the price of this policy for year 2012. The client requires a policy for year 2012. Now, you need the exposure for that year. In this case, the exposure is turnover, and you also need the turnover for, let's say, around 10 years of past claims. You need the exposure for all the turnover for all the years for which you have claims. Otherwise, it's not, you cannot connect the previous exposure, the amount of claims that you had in a particular year, with the amount of risk that the client had. I think we explained that to some extent already in chapter 1. I just wanted to mention that exposure is an important concept, and we have looked at it already in our first lecture quite extensively. We discussed it quite a bit. We have spoken about how to calculate earned exposure, etc. But if at this stage it's not clear to you completely what exposure is, I invite you to read quite carefully section 8.3. Let me see if this appears. No, something is wrong with my optical pen now. In any case, section 8.3 in the textbook, that will give you quite lengthy explanation of what exposure is and what type of exposure is good, and some criteria to define what a good measure of exposure is. And actually I recommend that you read that quite carefully anyway, whether you think you already know what exposure is sufficiently or not, because it will be a recurring theme of this course. Okay, moving on. Exposure data. Yes, what we saw in the previous slide was exposure data for experience rating. So rating, pricing made on the basis of past claims experience. As you certainly know, and as we will see later on, there's another type of pricing, another way of doing pricing, which is called exposure rating. That is rating based not on the claims experience of the client, but on general benchmark information that you find in the industry. And you have to resort to this type of pricing when you don't have enough information about the client, of course. And sometimes you want to look at both experience rating and exposure rating. Exposure rating will be is an important subject for pricing, something that we'll be looking at quite closely, and it is the subject of chapter 21 and chapter 22. We will address both of these chapters in future lectures in the class or offline or online. But at this stage you don't know much about exposure rating unless you've done it in your workplace, and so I don't want to spend too much time about it. The only thing here that I invite you to consider is the type of information that you think could be useful when pricing property damage for a large company. Now, if you can think of this a bit on your own, it will probably help you when later on we're going to speak about exposure rating in detail, to understand why some type of information is asked. I don't put the answer to this here, but of course you will find it in the book in section 8.3.3. And actually I have included here, but let me skip it now and move on to coverage data. Now, coverage data is actually part of policies data, really. But here I've looked at it separately because this is very important and merits being looked at on its own. What I would like especially to emphasize is that, of course, we know in order to price our policy, we need to know what the structure is. We have seen it from lesson 1. So we need the current and the prospective, the insurance structure, the limit, deductible, the annual deductible, all this information for the policy that we are going to write. But what I'm stating here is that we might also need that information for the past. So looking at historical deductibles and limits. And I invite you to think why that is the case. And I'm not sure if I've put the answer here or not. I haven't, so think about it, and the answer you're probably going to find in the book, but if you still have doubts, let me know. It as a hint, it has to do with the fact that among other things, claims may be truncated or censored depending on the previous features of the policy that you write. Moving on again, I mentioned that we also need normally external market data or portfolio data, that is information that is not client specific. We want that when the client doesn't have enough data, and the type of data that we consider is, for example, claims data from other clients of ours, or from other, or in general from people from the industry. Information on the frequency of claims from the market, so how many accidents or claims there are for car insurance, for third-party liability insurance for motor in the market. That, of course, is something that is useful for us to know if we write motor insurance. The same thing for reporting delays, for payment pattern, how fast the claims are paid, how fast claims are settled, and then loss ratios for different lines of business. This is all stuff that we can calculate for our clients, for one specific client, but normally some of these things, for example, the payment pattern might be too shaky, too unstable if you look at it for a single client. Whereas if you look at the whole industry or the whole of our whole portfolio of clients, then data is much bigger and more statistically significant, and maybe we are better off using that rather than the information from a given client. I would stop here with